Hey everyone, welcome back to Corporate Dakota, the place where we dive deep into the fascinating and sometimes downright wild world of corporate filings. Today we're unboxing a filing from HarbourVest's Private Investments Fund, and let's just say understanding this one requires a bit of our signature Dakota magic, especially when it comes to where your money might be heading and what risks are lurking. So, what exactly is this document all about? Well, it is a registration statement that is like a company's official introduction to the public markets, telling everyone what it plans to do, how it will make money, and crucially, what could go wrong. For HarbourVest's Private Investments Fund, this is an update to their earlier filing, basically saying they're looking to raise even more money, a cool $1 billion on top of what they already had registered, bringing their total registered shares to a whopping $2 billion. This company is a closed-end investment fund, which means it has got a fixed number of shares and it is not diversified, meaning it can put a lot of its eggs in fewer baskets. Their goal is pretty straightforward: long-term capital growth. They plan to do this by investing in private investments, a bit like buying into companies that aren't on the stock market. They'll do this through direct investments, where they partner up with companies or buy into them fully, and also by investing in other private investment funds. Think of it like a fund of funds, but with direct stakes too. Now, they offer three classes of shares: Class A, Class D, and Class I. Each has different fees and costs, which is super important for your wallet. Class A shares come with a sales load, which is like a fee you pay up front when you buy, up to 3.5% Class D, and Class I shares don't have that upfront fee, but Class D can still have fees from the people who sell them. And Class I shares are generally for the bigger investors and have fewer extra charges. This distinction is key because those fees can really eat into your returns. Let's peek at the fee table for Class A shares. That maximum sales load is 3.5%. That might not sound like much, but imagine you invest $1,000. That is $35 gone right off the bat for Class D and I. It is 0% upfront. But then we have the annual operating expenses for Class A. It is a total of 5.10% before any waivers, dropping to 2.44% after they've smoothed out some costs. Class D comes in at 4.60%, then 1.94% after waivers. And Class I, the cheapest, starts at 4.35% and lands at 1.69% after waivers. The management fee is a pretty standard 1.25% annually. But here is a twist. The manager has actually agreed to waive all of that management fee until the end of 2026. That is a huge break for investors, essentially giving you a year and a half of management for free. But remember, after 2026, it jumps back to 1.25%, so keep that in mind. Then to raise the incentive fee, which is 12.5% of profits. This means the manager gets a pretty big slice of the pie if the fund does well. This fee is calculated based on how much the fund's value grows compared to its starting point, and importantly, it uses a loss recovery account. That is a fancy way of saying if the fund loses money, the manager has to make back those losses before they start earning that incentive fee again. Looking at the total annual expenses after waivers, Class A shares are looking at 2.44%, Class D at 1.94%, and Class I at 1.69%. These are still significant numbers, especially compared to simpler investments. The waiver on the management fee definitely helps, but those other expenses like the incentive fee and other operating costs add up quickly. This fee table also gives us an example of costs on a $1,000 investment over time, assuming a hypothetical 5% annual return. For Class A shares, you'd pay $59 in the first year, then $160 over 3 years, $260 over 5 years, and a whopping $511 over 10 years. That $511 is about half of your initial investment just in fees over a decade. For Class D, it is $20 for the first year, $115 over 3 years, $211 over 5, and $454 over 10. Class I is slightly better at $17 for the first year, $108 over 3, $199 over 10. It really highlights how those annual fees, even if they seem small, add up considerably over the long haul. Now, let's look at the fund's actual performance for the 6 months ended the 30th of September 2025. Class I shares started at $10. Per share, they saw a net investment loss of $0.08 per share, but a net realized and unrealized gain of $0.72 per share, bringing the net asset value per share up to $10.64. That is a total return of 6.40% for that period. For Class A and D shares, the numbers are very similar, with the net asset value also reaching $10.64 and a total return of 6.40%. This performance is good. But remember, it is for a very short period and doesn't include those upfront sales loads we talked about for Class A. But what about the risks? A big chunk of this filing is dedicated to them, and it's a long list. They invest in private companies, which are less transparent and harder to sell than public stocks. This means your money could be tied up for a long time, and you might not be able to get it out when you want. They also invest in leveraged buyout transactions, which use a lot of debt, making them more sensitive to market downturns. There are also risks related to investments in credit, special situations, and distressed companies which are inherently more volatile. A key risk they highlight is that the fund is non-diversified. This means they can put a large portion of their money into a single company or a few companies. If one of those investments goes bad, it could have a massive impact on the entire fund. Valuing these private investments is also a challenge. Since there is no public market, they have to estimate the value. This subjectivity means the NAV or net asset value could be inaccurate, affecting fees and the price you get when you sell. There is also intense competition to get into these private deals. The manager might not be able to secure the best opportunities for this fund because other funds managed by the same company might get priority, which is a potential conflict of interest. And when it comes to getting your money back, it is tricky. They offer to repurchase shares periodically, but they can limit how much they buy back, and in unusual circumstances, they might even pay you back with actual investments instead of cash, which could be hard to sell. Now, for a bit of a silver lining on the fee front, the advisor has contractually agreed to waive fees if other operating expenses get too high, ensuring that certain annual operating expenses, excluding a list of specific items, do not exceed 0.75% of the fund's net asset value. This is a good safety net, but it is important to note what is excluded from this cap. Things like interest payments, acquired fund fees, and other significant costs are not included, so the total expenses could still be higher than this figure suggests. Looking at the shareholders, HarbourVest's Partners LP itself holds a significant chunk of Class A and Class D shares, owning all of them as of late 2025, which shows a strong commitment from the parent company. For Class I shares, HarbourVest's Blue Spruce Fund LP holds a massive 99.50%. This tells us that the fund is largely owned by entities connected to HarbourVest, which could be deliberate to achieve certain investment strategies or could indicate limited interest from external investors. Overall, HarbourVest Private Investments Fund is aiming for high growth through private markets, which, if successful, can be very rewarding. However, the risks are substantial. The lack of diversification, the difficulty in valuing private assets, the long lock-up periods for your money, and the potential conflicts of interest are all significant factors to consider. The management fee waiver is a nice perk for now, but the substantial incentive fee means the manager is incentivized to take on risk to boost their own earnings. The company's strategy hinges on its ability to pick and manage private investments, with a heavy reliance on HarbourVest's expertise, the sheer volume of risks outlined in this filing. From market downturns to regulatory changes to the very nature of private markets, signals a high-stakes game. While the fund is registered and aiming for public investor access, the nature of its investments means it is definitely not for the faint of heart or those needing quick access to their cash. The performance shown is positive for the period, but it is essential to look at these private market funds with a very long-term perspective, understanding that significant fluctuations and potential for loss are part of the deal. So, what is my take? HarbourVest is a major player in private markets, and that experience is a definite plus, but investing in this fund means accepting a high level of risk and illiquidity for potentially higher returns. The fee structure, especially the incentive fee, is something to watch closely as performance unfolds. It is a fund for sophisticated investors aware of and comfortable with the complexities and risks involved. Alright, that is our breakdown of HarbourVest Private Investments. Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.